Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 74, titled Strike Selection Using Technical Analysis and Market Assessment. We're going to use a real-life example with Quidel Corp, which trades on the Nasdaq exchange under the ticker symbol QDEL. Let's start off with a definition of what is technical analysis. Well, it's a method of predicting future price stock movements based on historical price movements. Now, in the BCI methodology, we use 4 parameters. You could select your favorites, but these are the ones that I've had tremendous success with over the last 2+ decades as it relates to short-term option selling. In the BCI methodology, we use 20-day and 100-day exponential moving averages. Now, the difference between an exponential and a simple moving average is the more recent prices are weighted more heavily in the trend line, so that we'll be able to see quicker movements. And since we're taking on short-term obligations, that's important to us. We're also going to have a look at the MACD histogram, which is both a trend and a momentum identifying parameter. We're going to look at the stochastic oscillator, which is a momentum indicator. And finally, we're going to look at volume to confirm the other parameters, as well as looking for a volume divergence to see whether or not the current trend is supported or not supported by the amount of volume that's involved with that particular security. Now, if we were to look at a price chart of QDEL at the time of March 2020, when I'm making this particular video, you would see that the price on the momentum side and on the trend side was all bullish. So if we looked at the top part of a price chart, we would see that both the 20-day and 100-day exponential moving averages are uptrending higher. And that's a pretty sight for those that read technical charts. Now, the shorter-term 20-day EMA is higher than the 100-day, a bullish signal, and the price bars are at or above the 20-day EMA, all bullish signals. Now, if we looked at the MACD histogram, the blue bars, you would see that they are above zero and had moved from below to above zero on the right side of the price chart, also a bullish signal. Further down below the MACD histogram, you would see the stochastic oscillator, which had recently been uptrending and is now above the 80th percentile. Some people may read that as being overbought, but I have seen stochastic oscillator lines above the 80th percentile for months at a time. So I still consider this a bullish signal until and if and when it drops below the 80th percentile. And finally, you could see from the chart, if you were looking at the chart, those of you viewing this podcast, you would see that the volume bars are tremendously high, and that's supporting these bullish indicators. And so there is no negative volume divergence here, all bullish on this price chart. So that's part of the story. Now, if we took a look at the S&P 500, the 3-month price chart, and VIX comparison chart, wow, that is something else, because this happened right during the COVID-19 crash in March of 2020. At that particular point in time, if you looked at a chart in March, you would see the VIX, the CBOE volatility index, was up a whopping 428%, a really bearish signal. And the S&P 500 in that 3-month time frame went down 31%. Ouch. So even though QDEL had a really pretty price chart, the overall market assessment was very, very bearish at that point in time. So if we were to look at an option chain for this security at that point in time, QDEL was trading at 88.75. We would probably favor an in-the-money strike to get the additional downside protection of the intrinsic value component of in-the-money strikes. So if we looked at the 80 strike, now QDEL's trading at 88.75, so it's $8.75 in the money, you would see a bid price of $13 per share, $1,300 for the contract. Now, what we do is we take this information and feed it into the multiple tab of the Ellman calculator. And the following would be noted. The break even moved all the way down to 75.75 from 88.75. So that is a significant amount of downside protection. Now, the time value component of the $80 strike still generated a return on the option of 5.3%. This is a one month return. And it's so significant because when the market is as volatile as it is, the premiums will be that much higher. So we're getting a 9.9% downside protection of the 5.3% initial time value profit. That's not the same thing as break even. What that means is the price of the stock can move down by 9.9%, no more than that, and we still will have realized our full 5.3% 1 month return. So when we have a market as volatile and as downtrending as we have, despite a very bullish technical chart, we probably would lean towards this in the money strike. So let's summarize. There are many factors that we should consider when selecting certain underlying securities, and the strike prices for covered call writing. Same thing would apply to put selling also, based on chart technicals and overall market assessment. We would take the more bullish positions basically out of the money strikes when both chart technicals and market assessment are bullish. In this particular case, we only had half of that. We had a bullish chart and we had a very negative overall market assessment. So if either component is compromised, as it is in this particular case, we might lean towards selling in the money strikes, or a certain substantial percentage of our strikes being in the money to provide that cushion for capital preservation. Because remember now, in the money strikes have the intrinsic value component, which gives us greater protection to the downside. Just as a reminder before I go, I want you to know that we use the Ellman calculator. You can get a free copy of that on our website, www.thebluecollarinvestor.com. Just click on the free resources link at the top black bar of our web pages, and you can download the calculator right to your device. We also have a free Beginner's Corner tutorial. Click on the upper right side there, and you can get two 8-part video tutorials, one on covered call writing, one on selling cash secured puts. All of our books and online streaming DVD programs, calculators, spreadsheets, online mentoring, all that information is located in the link that's marked store. So feel free to take advantage of both our educational products for sale as well as all the free resources on thebluecollarinvestor.com website. Ladies and gentlemen, thank you so much for taking the time to listen to this BCI podcast number 74, Strike Selection Using Both Technical Analysis and Market Assessment. Folks, I hope you enjoyed this podcast presentation, and most importantly, I hope it puts some cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.